If you think BlackRock is still watching XRP from the sidelines, then you're already late to the real story. While most people are staring at daily candles and arguing over whether $2 will hold, the largest asset manager on the planet has been quietly positioning itself inside the XRP ecosystem, not through headlines, not through hype, but through infrastructure. This is the kind of move that retail usually notices only after the price has already moved, and by then, the opportunity is gone. Welcome back to BullionIQ, the channel where we don't chase price, we track power, liquidity, and institutional intent. If you're new here, this channel is about understanding how money really moves, especially in crypto, where the biggest shifts happen long before they show up on your chart. Today's video is not about short-term pumps or emotional trading. It's about why BlackRock's involvement with Ripple and RLUSD could represent one of the most important structural shifts XRP has ever seen. Let's get one thing straight early. BlackRock managing over $10 trillion is not just a big number. It is a scale so large that the entire crypto market, sitting around $2.5 trillion, looks small in comparison. When an institution like this steps into any ecosystem, it doesn't bring speculation, it brings gravity. And gravity changes everything around it. This is why the rumors about BlackRock adopting RLUSD are not just noise. They point to a deeper plan that most retail traders aren't prepared for. RLUSD is not designed to compete with meme stablecoins or retail payment tools. It is built for institutions that need speed, compliance, and predictability. By positioning RLUSD as a core collateral asset for tokenized funds like BULL, BlackRock is effectively opening a door between traditional finance and the XRP ledger. This isn't a marketing partnership, this is plumbing. And in finance, whoever controls the plumbing controls the flow of capital. This is where many people misunderstand what's happening. They think this is about XRP going up. In reality, this is about tokenization, the migration of trillions of dollars of real-world assets onto blockchain rails that operate 24/7. Bonds, treasuries, funds, credit instruments, all moving without waiting days for settlement. BlackRock itself has already said that the next generation of markets is tokenized securities. That statement alone should make you pause. While retail investors feel exhausted watching XRP hover around the same price levels, the smart money is doing the opposite. Accumulation doesn't look exciting. It looks boring. It looks frustrating. And that's exactly why it works. The growth of RLUSD since its launch shows what institutional adoption really looks like. It doesn't explode overnight, it expands steadily, quietly, and then suddenly becomes unavoidable. As we sit here in late January 2026, the signal is becoming clearer. BlackRock doesn't need Ripple because it's trendy. It needs Ripple because the global financial system is broken at scale. Settlements take too long, fees are too high, liquidity is trapped in silos. To move tokenized assets globally, you need a fast, compliant, neutral settlement layer. That's the problem Ripple was built to solve. This is also why on-chain data matters more than opinions. While sentiment on social media shows fatigue, the blockchain shows movement. XRP velocity has increased during consolidation phases, a classic sign that large players are positioning while attention is elsewhere. Exchange reserves dropping from billions of tokens to nearly half that amount is not random behavior. That is supply leaving liquid markets and entering long-term custody. And this is where retail usually gets it wrong. By the time headlines confirm institutional adoption, the supply is already gone. Price doesn't move first. Structure does. Liquidity does. Infrastructure does. Prices always last. So here's the question I want you thinking about as we move deeper into this breakdown. If BlackRock is building on XRP rails, are retail investors truly early, or are they being slowly priced out while institutions accumulate quietly? Drop your thoughts in the comments, because this divide between retail exhaustion and institutional confidence is the most important signal in the market right now. You first need to understand the real problem they are trying to solve. It is not crypto adoption, it is not price appreciation, it is scale. BlackRock operates inside a financial world where trillions of dollars are locked inside systems that were never designed for speed, transparency, or 24-hour operation. Assets are fragmented across legacy databases, correspondent banks, custodians, and clearinghouses. Every transfer introduces delay, risk, and cost. Today, most traditional assets still take anywhere from 1 to 5 days to settle. That may not sound like a big issue for retail investors, but for institutions moving billions, every hour of delay represents capital that cannot be reused. Multiply that inefficiency across global markets, and you are looking at billions of dollars lost annually to friction alone. This is the $100 trillion problem, not a lack of money, but a lack of efficient movement. BlackRock's BuLL fund was the first public signal that they are serious about tokenization. By placing real-world assets like U.S. Treasuries onto blockchain rails, they proved that institutional-grade tokenization is not a theory, it works. But proving it at a pilot level is very different from scaling it globally. To scale tokenized funds, BlackRock needs a settlement layer that is fast, compliant, and stable. This is exactly where Ripple enters the picture. The XRP ledger was built from day one to move value, not just data. Unlike congested networks that struggle under load, the XRP ledger can settle transactions in seconds at extremely low cost and with deterministic finality. For institutions, this matters more than decentralization purity. They need certainty. They need compliance. They need predictable performance at scale. This is where RLUSD becomes critical. Institutions cannot rely on volatile assets as collateral. Price swings introduce risk that compliance departments simply will not accept. RLUSD solves this by offering a stable, dollar-backed unit that can move at blockchain speed while maintaining regulatory alignment. It bridges the gap between traditional finance expectations and blockchain efficiency. What makes RLUSD different from retail stablecoins is its design philosophy. It is not meant to be used for speculation or casual payments. It is meant to act as institutional-grade collateral, backed by cash and treasury equivalents. This allows tokenized assets to be issued, traded, and settled without exposing institutions to unnecessary volatility. This regulatory-first approach is exactly what BlackRock needs. Moving from experimentation to full-scale infrastructure requires more than speed. It requires trust from regulators, auditors, and counterparties. Ripple's long-standing focus on compliance positions it uniquely in this environment. This is why RLUSD is not trying to compete on hype. It is competing on utility. By 2030, projections suggest that tokenized real-world assets could reach into the trillions of dollars. Bonds, funds, credit instruments, and even equities are likely to exist in tokenized form. Whoever controls the rails that move these assets will control a massive portion of global liquidity. BlackRock understands this. They are not chasing yield. They are building gateways. Using the XRP ledger as a base layer also allows institutions to bypass many of the problems seen on other networks. High fees, congestion, and unpredictable settlement times make many blockchains unsuitable for institutional use. Atomic settlement on the XRP ledger allows complex transactions to complete in seconds, reducing counterparty risk dramatically. For large financial players, this is a non-negotiable requirement. As these tokenization bridges strengthen, the line between a traditional bank account and a blockchain wallet starts to blur. Assets can move seamlessly between systems without manual reconciliation. This is not just an upgrade, it is a structural transformation of financial infrastructure. And while this is happening, something important is occurring beneath the surface. Institutions are positioning themselves long before retail sentiment improves. On-chain data shows XRP moving off exchanges and into long-term custody. This behavior is consistent with accumulation, not speculation. Large players do not chase green candles. They build positions quietly during periods of boredom and frustration. Exchange reserves falling by nearly 50% over a short time frame is not accidental. It suggests that supply is being removed from liquid markets. At the same time, institutional products like spot XRP ETFs are absorbing capital at a steady pace. This combination creates a setup where supply tightens before demand becomes visible. Retail traders often miss this phase because it feels uneventful. Prices consolidate, narratives fade, attention shifts elsewhere. But historically, this is the phase where foundations are laid. By the time excitement returns, positioning is already complete. So the key takeaway here is simple. BlackRock's interest in Ripple is not about XRP as a speculative asset. It is about Ripple as infrastructure, RLUSD as collateral, the XRP ledger as a settlement engine. This is how institutional finance thinks. And this is why these moves matter far more than short-term price action. And it is not one that shows up on a price chart. While the entry of giants like BlackRock brings liquidity, credibility, and scale, it also introduces control. This is the part of the conversation that often gets ignored because it is uncomfortable. But if we are going to analyze this space honestly, we have to address it directly. The version of decentralized finance that institutions are building is not the same one that early crypto users imagined. Institutional DeFi is not permissionless. It is structured, gated, and regulated. It operates inside walled gardens where access is granted only to participants that meet strict identity, compliance, and jurisdictional requirements. This does not make it evil, but it does make it different. RLUSD itself is a perfect example of this trade-off. Unlike decentralized stablecoins, RLUSD is centrally issued and centrally managed. This means it can be frozen, paused, or restricted to comply with sanctions or regulatory mandates. For institutions, this is a feature, not a flaw. For early crypto purists, it represents a loss of sovereignty. Both perspectives are valid, and both coexist in this transition phase. As Ripple aligns more closely with global regulators, governance risk becomes a real factor. The migration of foundation governance into jurisdictions like the European Union brings clarity, but it also brings obligation. Compliance with frameworks like MyCA means validators, issuers, and infrastructure providers may eventually be required to enforce rules at the protocol or network level. This introduces the possibility of exclusion for non-compliant participants. This creates what can be described as the bridge currency paradox. XRP was originally designed as a neutral bridge asset between currencies. But if stablecoins like RLUSD can move instantly and maintain price stability, institutions may prefer settling directly in digital dollars for certain corridors. That raises an important question. Does the success of RLUSD strengthen XRP, or does it reduce the need for it in some use cases? The answer is not binary. XRP and RLUSD serve different functions. XRP provides liquidity and acts as a bridge where direct liquidity pairs do not exist. RLUSD provides stability and regulatory comfort. In many cases, they will coexist. In others, RLUSD may dominate. Understanding this balance is critical for long-term analysis. Another layer of complexity is the concept of permission domains on the XRP ledger. These domains allow issuers to restrict access using digital identity credentials. From an institutional standpoint, this is necessary. Banks cannot operate in environments where counterparties are anonymous. From a decentralization standpoint, this represents a shift away from open access. This is the cost of clean crypto. The industry is moving from experimental freedom into regulated efficiency. The benefits are real: faster settlement, lower costs, global interoperability, but the trade-off is reduced anonymity and increased oversight. Investors need to understand that this is not a temporary phase. It is the direction the industry is moving. Despite these concerns, institutions are not slowing down. In fact, they are accelerating. One of the most significant developments supporting this shift happened quietly inside the core banking world. DXC Technology announced a partnership to integrate Ripple's custody and payment logic directly into the Hogan core banking platform. This was not a crypto headline. It was a banking infrastructure upgrade. Hogan is the operating system for hundreds of millions of bank accounts worldwide. When Ripple technology is embedded at the vendor level, adoption no longer depends on individual banks building custom integrations. It becomes a configuration option, a software update. This dramatically reduces friction and speeds up institutional rollout. This is the moment where blockchain stops being an external experiment and becomes internal infrastructure. Banks do not need to adopt crypto. They simply enable a module. RLUSD payments, digital asset custody, and tokenized settlement become native features of their existing systems. This is why this development matters more than exchange listings or influencer hype. It represents last-mile connectivity, the point where theory becomes production, where blockchain utility moves from white papers into daily financial operations. And once these rails are live, demand for efficient liquidity naturally increases. Institutions do not want dozens of assets. They want the most reliable bridge, the most predictable settlement layer, the asset that works quietly, consistently, and at scale. At the same time, this institutional embrace introduces responsibility, compliance requirements increase, transparency increases, risk disclosures become unavoidable. This is why it is important to understand that none of these developments guarantee price appreciation. Infrastructure adoption does not move markets overnight, but what it does do is create a long-term floor, a base of sticky capital that does not trade emotionally, that does not panic sell, that builds positions based on utility, not sentiment. We've talked about infrastructure, liquidity, and institutional adoption. Now it's time to discuss one of the most important technological changes coming to the XRP ledger, the XLS 66 amendment. This upgrade is not just a minor tweak. It has the potential to transform XRP from a static, passive asset into a productive, yield-generating tool that can directly support institutional operations. This is where the ecosystem begins to show its full potential. For years, one of the biggest challenges in decentralized finance has been over-collateralization. Traditional DeFi protocols require users to lock up far more capital than they intend to borrow. This is fine for speculation or experimentation, but it is a massive hurdle for real businesses. Institutions cannot afford to tie up millions of dollars in collateral just to access short-term liquidity. XLS 66 addresses this issue directly by introducing under-collateralized fixed-term loans. Here's how it works. Instead of requiring full collateral upfront, the protocol uses a credit-based system. Borrowers provide verified off-chain credentials to trusted brokers, who then release capital from on-chain liquidity vaults. This means working capital can flow without locking up massive amounts of cash or assets. The brokers have skin in the game. They must stake their own first loss capital, which ensures accountability and risk management. This isn't some experimental feature. It is professional-grade credit infrastructure built for institutions. By enabling this type of on-chain lending, the XRP ledger effectively becomes a central hub for institutional liquidity. Banks, fintech companies, and corporate treasuries can tap into these loans to finance operations, pay suppliers, or manage cash flow, all in real time and on-chain. The system is designed to absorb institutional working capital, creating what can only be described as a liquidity black hole. Money flows in, gets used productively, and circulates continuously without leaving the ledger. When you combine this with the DXC-Hogan integration we discussed earlier, the implications are enormous. Traditional banks are now capable of accessing on-chain liquidity directly through their existing systems. A treasury team doesn't need to learn blockchain or manage wallets. They can simply authorize capital movement through the ERP or banking software they already use. XRP becomes the hidden engine powering institutional finance. This change also shifts the perspective on price and supply. Previously, retail traders looked at XRP as a speculative coin, moving up and down based on sentiment or news. Now the asset becomes part of a larger financial infrastructure. Liquidity demand is driven by operational necessity, not emotion. That's why exchange reserves dropping and institutional accumulation occur quietly without media fanfare. These movements are not speculative, they are functional. Another key element is the integration of tokenized stablecoins like RLUSD with this system. XLS66 loans can be issued and settled in RLUSD, combining stability with speed. Institutions no longer need to deal with the volatility of other crypto assets. They get the best of both worlds: blockchain efficiency and predictable collateral. This synergy between XRP, RLUSD, and the ledger's new lending capabilities creates a financial environment that is optimized for scale and compliance. The potential volume here is staggering. When under-collateralized loans go live, billions in working capital could be deployed directly on-chain. Each dollar circulating through these vaults is productive. It generates yield, enables real-world transactions, and supports the broader institutional ecosystem. XRP transforms from a passive store of value into a tool that literally powers finance. This also changes the way we think about market cycles. Historically, crypto investors measure risk and reward based on supply and demand charts, social sentiment, or technical analysis alone. With productive XRP, fundamental demand starts to matter more than ever. The assets being used to generate credit are not leaving the ledger. They are locked, circulating, and creating a structural floor that protects price from speculative collapses. At the same time, this system introduces new considerations. Governance, compliance, and counterparty risk all become central. While the technology allows for efficiency, it also requires robust oversight. Institutions using XLS66 loans need trusted brokers and fully compliant participants. The system is no longer purely permissionless. It is professional, structured, and designed to meet the standards of traditional finance. Yet despite these trade-offs, the upside is enormous. When these features are fully operational, XRP and RLUSD together could form the backbone of institutional DeFi. Banks, asset managers, and treasuries would no longer rely solely on legacy rails. They would have a fast, compliant, programmable financial ecosystem operating 24/7. The potential to scale trillions of dollars in assets becomes realistic, not theoretical. Finally, this is the reason why institutional investors are quietly accumulating XRP, even when retail sentiment appears exhausted. They see the infrastructure, they see the productive applications. They understand that these moves are about long-term structural adoption, not short-term price speculation. By the time the market narrative catches up, a foundation has already been laid for years of liquidity growth, XRP in the months and years ahead. We've already seen how BlackRock's involvement, the rise of RLUSD, the XLS66 lending protocol, and the DXC-Hogan integration are laying the foundation for a completely new financial ecosystem. But how does that translate into market reality? Why should this matter to you as an investor or a market watcher? First, consider the mechanics of supply and demand. Institutional accumulation is quietly removing XRP from liquid markets, while retail sentiment remains tired and stagnant. Exchange reserves have dropped significantly, meaning fewer tokens are available for day-to-day trading. At the same time, demand is not speculative. It is structural. ETFs, treasury-backed funds, and tokenized real-world assets create a sticky capital base. When supply is tight and demand is operational rather than emotional, even modest buying can move the price aggressively. This is why some of the price targets that seemed unrealistic a year ago are now being seriously modeled by professional analysts. A combination of structural demand from ETFs, liquidity from XLS66 loans, and the ongoing adoption of RLUSD could push XRP into price levels that would surprise the retail market. Remember, this isn't about hype, it's about math. Supply tightening, liquidity being funneled through professional channels, and trillions in real-world assets being bridged onto the ledger. The role of RLUSD cannot be overstated. By providing a stable, regulatory-compliant medium, it allows institutions to move massive amounts of capital without introducing volatility risk. This stablecoin becomes the connective tissue for tokenized securities, on-chain credit, and global liquidity flows. XRP itself provides the bridge liquidity where direct RLUSD pairs do not exist. Together, they form an ecosystem where the ledger can handle institutional-scale finance efficiently. XLS66 adds a second dimension. This protocol transforms XRP into a productive asset. Unlike traditional crypto holding, which relies on price appreciation alone, XLS66 enables institutions to use XRP as part of a real-world credit market. Loans can be issued, capital can circulate, and liquidity demand creates a built-in, ongoing reason for accumulation. This is where XRP stops being a speculative token and starts being a core infrastructure tool. Combine this with the ETF supply dynamics, and you begin to see a potential multi-layered price effect. ETFs lock in capital for months or years. XLS66 creates predictable institutional demand. RLUSD ensures stability for transactions and collateral. Exchange reserves shrink while on-chain liquidity grows. Each of these forces compounds the other, creating a structural foundation for a sustained move. It's also important to note that these developments are not theoretical. DXC-Hogan integration means banks don't need to experiment or implement complex APIs to use the XRP ledger. Adoption is now a simple software switch. For every treasury team, corporate bank, or institutional fund that activates these rails, more XRP moves into long-term custody. This is slow, quiet accumulation, but it has far-reaching consequences for liquidity and pricing. Now, let's be honest, there are risks. Centralization aspects of RLUSD, permission domains, and compliance-driven governance all mean that the system is no longer purely decentralized. This introduces counterparty, regulatory, and governance risks. Investors need to weigh these factors carefully. The upside is high, but it comes with a new type of systemic structure that differs from the early Wild West days of crypto. Understanding this is part of acting like a professional analyst rather than a retail trader. From a technical standpoint, the consolidation phase we've observed is healthy. Historically, periods where retail is exhausted and institutional accumulation continues quietly are followed by rapid vertical moves. Fibonacci retracements, liquidity gaps, and support resistance clusters all suggest that XRP is building energy for the next leg. Analysts are projecting key resistance clusters that could redefine long-term floors, especially if institutional inflows continue as anticipated. So what does this all mean for you? It means that the XRP ecosystem is no longer just a speculative playground. It is evolving into a professional-grade financial infrastructure. BlackRock, DXC, and other major institutions are not here for memes or hype. They are here to build operational capacity, liquidity networks, and tokenized asset flows. The retail market is late to the party, but it is not irrelevant. Those positioned ahead of the next vertical leg have the opportunity to participate in a structural growth story rather than a short-term pump. BullionIQ has always focused on tracking institutional flows, regulatory alignment, and real-world adoption. This is why understanding the combination of RLUSD, XLS66, ETFs, and integration into banking software is critical. Watching price alone won't give you the full picture. Understanding infrastructure, liquidity, and the flow of capital will. To summarize, the next wave of XRP growth is not speculative. It is built on institutional adoption, stablecoin integration, productive credit protocols, and global financial infrastructure. Supply is tightening, demand is structural, and the ledger is now capable of supporting trillions of dollars in tokenized assets. For those willing to watch, learn, and position strategically, this is a rare opportunity to participate in a transformation of global finance. If you want to stay ahead, pay attention to the flows of institutional capital, track on-chain liquidity, and consider how tokenized real-world assets interact with XRP. This is where professional-grade analysis beats retail speculation every time. As always, do your due diligence, understand the risks, and focus on structural developments rather than hype. BullionIQ will continue to provide updates on institutional flows, protocol upgrades, and market mechanics as they unfold. If you're ready to take your understanding to the next level, make sure you're subscribed, turn on notifications, and join our Discord for real-time insights and professional analysis.